सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Usually in Macrosutra, we discuss the latest data that has come out or the latest trends that we are seeing in the macroeconomy. But this time we're going to take a little break from that and instead discuss a recent paper that has been published by an RBI, former Deputy Governor of the RBI, Mr. Viral Acharya. He published this in the Brookings Institute, where he's talked about various things, but one of the interesting aspects was where he postulates that maybe India should look into breaking up the top 5 big companies in the economy. So that's the question that we're going to discuss in this episode of Macrosutra. I'm TCA Sharad Raghavan, economy editor at ThePrint, and we have with us Radhika Pandey, a senior fellow at NIPFP, and who has written an article about this topic and has found that actually the dominance is not that big of an issue, and we'll go into the details of that. Thank you so much, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, let's start with what Mr. Acharya has said about this topic. Like in a nutshell, what is his argument?
So he has published this paper at the Brookings Institute in a recently held conference. He's talked about a number of issues and challenges that are faced by India's economy. Right. He's also talked about the various opportunities with the as of now. But there are a lot of things that he's talked about. He's talked about problems with the industrial sector, the problems with the macroeconomy in general. So with regards to macroeconomy, he's saying that fiscal deficits should be lowered, tariffs should be reduced. So if we want to take advantage of the China +1 strategy, we need to lower our tariffs and improve our competitiveness. So all those things are not disputed. They are all well agreed and well understood points. The only recommendation that requires more deeper analysis and which requires some more thinking and consideration is the fact that he talks about the big 5 industrial houses.
Right.
So he's saying that the top 5 industrial houses, namely the Ambani Group, the Adani Group, the Tatas, the Aditya Birla Group, and the Bharti Telecom Group,
right.
They have captured the share of the other firms in the sector, and therefore they have gained what is called the pricing power. They
Right.
have gained, they have increased their presence in most of the sectors in the non-financial segments, like in metals, in chemicals, in non-metals and minerals. So what they have done is that there has been an increase in concentration in
Right.
terms of their share, and therefore because they have a greater share, they are able to wield a greater influence on prices. So
Right.
they are able to charge higher prices, and those prices are much higher than the input costs. Which
Right.
is typically in economic jargon we called it the markup, which is that if your input cost increases by 1%, how much your product prices increase.
Absolutely.
So because they have market dominance, this is what his contention is, that because they have market dominance, they are able to charge a higher markup.
That the consumer has no choice but to pay that higher
Yes.
price.
So and therefore this he is linking with the persistent core inflation in the economy.
Right.
So he's saying that because of this, whatever the high inflation, the elevated core inflation that we are seeing, which is when we strip food and energy prices out
Right.
of the headline inflation, because the reason why this core inflation is high is because of the pricing power of these 5 industrial houses, and therefore the steps should be taken. The Competition Commission of India should step in and dismantle these conglomerates. So that is the basic summary, the key argument that he makes, that has caught attention of a number of stakeholders and policymakers makers, and they have been talking about it. And this is what we try to examine in this article for one of the sectors.
Right. So what has your research found? Is there actually this kind of concentration happening, or is it that because these companies are so visible to us, it seems as if there is concentration happening?
Yes, so that's a very nuanced point, because as of now, because it's a very comprehensive paper, a lot of work has gone into it. So we have started with looking at just one sector, which is the metals segment,
Which is a very important
which is like the commodity space that we talk
Yeah.
about: aluminium, copper, ferrous metals, non-ferrous metals, and so on. So because this is one of the sector that the paper also looks into, so we have also tried to assess whether we find concentration has increased by these top 5 industrial houses over time. So
Right.
that is what is our line of inquiry. So there are 2 questions that we try to address. One is whether there is an increasing evidence of concentration in the metals segment by these top 5 industrial houses, and secondly, do they have pricing power?
Right.
So these are the 2 questions. Without going into regressions and complicated equations, we just look at the data, and also we look at the nature of this segment, because
Yeah.
each segment is different. It has its own characteristics, and when we do this kind of analysis, it's always proper to look at sector by sector. And within sector also, there are a lot of differentiation. When you
Right.
say metals, you have aluminium also, you have copper also,
Yeah.
and the market is different, the characteristics are different, the tariffs are different. So all these things need to be taken into account, which is what we try to do in this analysis. And so basically the simple thing we have for concentration, we do 2 very small tests. One is what has happened to the number of firms in this segment.
Right.
Okay, because if there is increase in concentration, it should have resulted in entry barriers.
Right.
New firms would not have entered into this sector. But if we see from 1991 till 2020, we see that the number of firms has increased. So there
Okay.
were around 439 firms in 1991, and
Right.
now there are plus 1200 plus firms in 2020.
Okay.
So that is one very small, simple test to see whether there is concentration, there are entry barriers. Because if there would have been such significant entry barriers, it would not have nudged new firms to enter into this field.
Only big players would have wanted to enter, and the smaller ones would have
Exited, or they would have been captured by bigger firms, and therefore the number of firms would have reduced rather than increasing. But what we find is that the number of firms has increased.
Okay.
Even though the pace of increase has slowed in the last few years, which is 2015 onward,
Okay.
which is what Dr. Acharya also says, that whatever concentration he's talking about has mainly accentuated only post 2015.
I
But we need to see that 2015 to 2020 is a very abnormal period, where the economy has been rocked by multiple shocks. We had
Right.
demonetization, we had GST, then we had COVID, we had the war, where the smaller firms would be disproportionately impacted as compared to the bigger firms.
Right.
And also, this is the time when infrastructure investment slumped. It's only in 2020 we are seeing that, with this
rise.
government strategy of reviving the economy through infra investment. But before that, it was falling. So if infra investment will fall, new firms will not like to enter, but still they entered. Only the pace of entry has slowed down in the last 5 years. But if we look at a longer horizon from 1991 till 2015, number of firms has increased.
Right.
So this is one metric. The other metric we look, what the paper also looks at, which is the share in the overall sales of the metal segment. What is the share of top 5, then the share of 6 to 10, and then the share of others.
Okay.
So what we are seeing is from 1991 till 2020, the share of top 5 has reduced.
Oh.
62% in 1991, the share has reduced to 47.
So that in itself shows that concentration is not happening.
Yes. So again, 2 small points. 91 to 2020, overall concentration has reduced because the share of top 5 has gone down, and concomitantly the share of others, not
Right.
6 to 10, the smaller firms, their share has increased.
Has increased. I see.
So if we see that way, only point again is that from 2015 onward, this trend was reversed. Again, so the share
see.
of top 5 from 2015 to 2020 rose. But if we take a longer time horizon, from the 15 years from 1990 till 2015, the share was falling. Only for this 5-year period, the share was rising. So what we are trying to say is that don't just look at this brief 5-year period.
Right.
Compare the last 20 years, and then we should base our assumptions, particularly because this 5-year period is an abnormal period. And therefore, and now that the economy is recovering, it may well be that the trend that we saw over the last 15 years, we will see that trend again catching up, that the
Right.
share of new firms, the other firm, not the top 5, not top 6 to 10, but the others will start rising. So
Right.
that is the crux of what we see in terms of concentration.
And when we talk about the macroeconomy, actually, that is an important thing to keep in mind, that the time periods that you
Yes,
look at
yes.
can really alter the data sets that you have. And when you're talking about the macroeconomy, usually it's better to look at longer time periods. Of course, there'll be periodic anomalies, but it's only when you look at the longer time period that you can tell that this is an anomaly and not the trend. So that's what Radhika has done, and I think that's actually a very useful analysis.
Yeah.
So now you had mentioned this about how we should look at it sector by sector, and we have a question from the audience about exactly that, which is that, do you think that such questions should be deliberated on a sector by sector basis rather than in a more generic top 5 way?
Absolutely. This is a very good question, and this is how this question needs to be investigated sector by sector, because again within sector also there are various sub-sectoral classification.
Right.
So if we look at what is our industrial classification, we go by what is called the NIC classification,
Right.
NIC 2-digit classification, and then within that there are sub-sectors where we go to NIC 3-digit, 4-digit, 5-digit, and so on. And therefore, when we investigate these kind of questions, we need to go as specific, as narrow as possible, which is what the competition regulator also tries to do. Because, as I mentioned, the market for aluminium would be different from the market for copper. So, but when you are taking metals, you will group them into one component. So it's always better to look at sector by sector and also look at the nuances of each sector. As an example, in metals, as I pointed out, what is the second question, whether there are pricing power, whether these firms wield pricing power.
Right.
Now, the nature of metals is that it's a tradable commodity.
Yes.
Now, when there is an option for consumers to either buy domestically or import, then in that case, the domestic producers do not have a very large scope for increasing the prices.
Because people will just buy from
abroad.
Right.
Also because the tariffs in this sector is very low.
Right.
It's not that the domestic industry is getting a lot of protection through high tariff barriers, and therefore aluminium producers in this field can manage to charge high prices. They cannot afford to charge higher prices, and which is what we show in our paper also, where what we are showing is that the world aluminium prices and domestic aluminium prices, they are just co-moving. They are just like superposing.
Which means that there's no, dominant companies are not really exerting their power on prices.
Yes.
It's more the world market
It's the world market. Whatever is happening in the world market, that will influence the trajectory of domestic prices, which is also another way of looking at it is compare the raw material prices and product prices.
Yeah.
Okay, so if your raw material prices are rising by say 5%, you cannot raise the product prices by 15%. So that is what we see again, where we have shown, we plot a graph between the growth of raw material prices and growth of sales.
Or rather,
again, they are right. They are superposed.
Right. So rather, like a dominant company, if it was truly dominant, would be able to charge the final price way more than the raw material.
Absolutely.
But the fact that they're moving together means that this dominance is not...
So that is why this question is very relevant, that, metal is a sector which is a tradable commodity. We've talked about this earlier, international prices. Aluminium is a international tradable commodity. We get the prices from the World Bank. Pink sheet give the prices, and domestic prices are just mirroring the international prices. And in that context, it's very hard to claim that, the top 5 in this segment are able to influence the prices.
Right. And now we should make clear that Dr. Acharya and also our analysis is restricted to private sector companies.
Yes.
But we have a question from the audience which is worth asking. It's should India break up its public sector companies? And then he asks, they ask which PSU should it break and which state PSUs should be broken. But first of all, the question is, should the PSUs be broken? Is broken the term that we can use for PSUs?
I think the better term or the better approach is privatization or disinvestment of PSUs, which is one of the stated policy of the government, that they are trying to reduce their stake. At least the policy statement is that they want to reduce their stake, leaving aside a few strategic sectors. They want to reduce their stake. We have seen a handful of disinvestments happening in the recent past, though the momentum has waned gradually because of the market volatility and the fluctuation that we are seeing. But I think we are on path to move on this question. So I think it's the appropriate approach should be to look at the privatization or disinvestment of PSUs rather than breaking.
And we've talked about the disinvestment plans of the government before in previous episodes. So we have various perspectives on that, but you can go to those previous episodes and see what those are. But now coming to another audience question, this I think comes down a little bit to what I had mentioned about the perception of monopoly versus actual monopoly. They ask, do you think with the kinds of acquisitions and mergers and takeovers of small businesses that are happening, the day is very near that in each specific sector, whether it's power, construction, consumer retail, we'd start seeing a monopoly of one firm rather than perfect competition?
So I think there are 2 points here. One is that not all mergers and acquisitions are bad. That you mentioned about perception. In the recent past, particularly during the COVID year, we had seen Byju's acquiring a lot of smaller startups because it wanted to expand its influence at a time when online classes were gaining momentum. So some of M&As are driven by business considerations, strategic considerations, which are in the long run good for the economy and good for consumers, because the footprint of the business increases, the outreach of the business increases, accessibility to consumers increase. So not all M&As are bad, and therefore these are driven by strategic consideration. The second aspect is that we have a competition regulator, a very active watchdog, competition watchdog, and it regulates the mergers and acquisitions and all kind of combination. And recently the Competition Act has been amended to further expand the remit of the regulator. So earlier mergers and acquisitions were above a certain threshold of asset or turnover required approval of the CCI, but now the deal value is also added as one of the criteria, where I think 2,000 crore or above combination or acquisition requires the approval of the CCI. And whenever the CCI does the investigation, and it's mentioned in the Act that they have to demonstrate that there is no appreciable adverse impact on competition. So with all these things, safeguards in place, we should be sure that, you know, if M&As are happening, they are for good. They are good for the economy. They are driven by strategic considerations, and we do have a competition regulator where on multiple instances they have brought to the notice of various manufacturers that, look, we are investigating and we are finding that you are engaging in anti-competitive activities.
Right.
They have been fined also. So therefore, we should not be so much concerned about that all sectors will have monopoly.
Right, absolutely. And no, it must be said that the CCI actually is a very active body. And if you want to actually see how active, you just go to the CCI website, go to their circulars on notifications page, and you'll see almost every day or at least several times a week, they come out with various orders to the small, like to you and me, it might seem like, I don't know what company this is, but the CCI is investigating everything. It's keeping an active eye on things. And I think that credit should be given to it. It is a very active body. And also, Radhika mentioned an amendment to the Competition Act. If you want to check that out, it happened in the recent budget session. So you just go back and go to PRS Legislative. They'll have a copy of the bill. It'll tell you what changes have been made. Now, we come to, you've looked at the metal sector, but I think there's one sector which is dear to all of us, which is the telecom sector. One of our questions from the audience is that in a sector like telecom, we see only a handful of companies which compete against each other. We don't see new players entering the sector, which is what you spoke about, entry barriers. Is it because of government regulations and policies which makes it difficult to run this kind of business? Or is it because of what Jio did in 2016, which has come up with very cheap data and voice plans, which then makes it kind of loss-making for other players to enter?
Yeah, it's a combination of both the things. But if we look at globally the structure or profile of the telecommunication sector, this is one sector where we do not see very many players, because telecommunication sector companies need to do a lot of fixed investments.
Upfront, they have to buy spectrum and all of that.
So the sunk cost is very high, and it's not possible. So that itself serves as an entry barrier. So it's not that there are some conscious entry barriers imposed, but the fact that the fixed investment is very high, the cost is very high, inhibits more players to enter, and therefore that's the trend that we see globally, that there are fewer players in the telecommunication sector. Now, coming back to India's telecommunication landscape, if we see, we've written this in some of the earlier episodes of Economist. 2 years back, the government announced a telecommunication rescue package for the telecom sector, because the average revenue per user of the companies were falling. There was dispute regarding what is the adjusted revenue, because the Department of Telecommunication was saying that in your revenue should include all revenues, not just the revenues from your core telecom operations, but also revenues from, say, sale or asset or investment. Whereas the telecom companies were saying that please restrict for this particular purpose, for paying the fees and spectrum charges to only telecom. So there was a lot of to and forth on this, and the Supreme Court ultimately ruled in favor of the DOT, and therefore that dealt a blow to telecom companies. Then in 2021, the government came up with a rescue package where it allowed a moratorium on payment charges for 4 years. So all these things are, happening, and that has caused problems with some of the telecom companies. Vodafone India
also stepped in with Vodafone right now.
Because so the companies that opted for moratorium, they had to at least pay interest on the deferred charges. And so Airtel was able to pay interest, but Vodafone was not able to pay. So the other option was to offer its equity to the government. So the government took over. So those are the developments, those are the important developments that happened in this space over the last 2-3 years. And then came Jio in 2016, offering 4G data free per day till 2017 for a couple of months. And because it was able to lower its cost and still provide services, it hampered the prospects of other companies, but it was because of its own cost cutting and its own investment that it was able to do this. So it was reducing the cost is not not an adverse business practice or an unethical business practice.
Correct.
So it's a combination of all these, and then globally also we don't see very many players because it involves a lot of cost. The setting up of towers. In fact, the other three companies have shared the cost for the Indus Tower and so on.
Yes.
So yes, those are the, again, as you know, we talked about that each sector has its own
unique
characteristics.
aspects,
So therefore, they need to be examined in that way, and also look at the policies that shaped their prospects over the last few years.
Right, and also you can be sure that if it ever turns out that Jio and Airtel are clubbing together and are deciding to raise rates together, then the Competition Commission of India will step in and take action, because that then becomes abuse of dominance.
Yeah, so recently they did for cement manufacturers.
Correct.
They had issued a warning that we have investigated, because they have their own investigative arm. They found that there were instances of collusion amongst the cement manufacturers.
Right.
So yes, so that is, it's an active watchdog.
So yes, and now we come to a larger, coming back slightly to the macroeconomic point. Question from our audience is that India is the 5th largest economy in the world, but if you look at the top 50 companies or the top 50 banks, we don't have any that feature in them. And so shouldn't it be that a country of our size should have the biggest companies and the biggest banks in the world?
Absolutely, we should. Other than the State Bank of India, we don't have big banks, and therefore even in companies also, if we want to compete with the Amazons or other companies, we need to have some big conglomerates to expand their supply chains, to be able to have horizontal and vertical linkages.
Right.
And that is possible only if there is what is called the making foray into a number of sectors. And therefore, what is important is when we do this kind of an analysis, it's important that what the company is giving back to the economy.
Right.
That is, what is the company doing in terms of generating employment? What is the company doing in terms of providing taxation? Not just look in terms of profit, which is what we do in a very fundamental macro concept called gross value added, where we look at the contribution of all the 4 factors of production. We look at labor, capital, entrepreneurship, land. So when we do this kind of holistic analysis, we need to see how much employment is being generated by these companies, and then make this judgment or take this call of whether we would like to dismantle these companies and then break not only these companies but also break the horizontal and vertical linkages that they have developed, the strategic decisions that they have taken, which ultimately in the medium run has benefited the consumers.
Right, absolutely. So, so in a nutshell, this is what we have. We had a paper by Dr. Acharya, which postulated this interesting idea that maybe the big 5 companies in India need to be broken up because there's an increasing concentration, and they're being able to use this dominance to impose prices or higher prices on consumers. Now, the analysis shows that while this might have been happening since 2015, that in itself is too small a period to actually judge anything. If you look back further to 1990 onwards or 1991 onwards, you find that concentration actually has not been increasing. And further, as Radhika's analysis shows, the imposition of prices is actually done more by the global market, especially in sectors like metals, which is very key to our economy. It's more the global market, it's not to do with dominant companies. And finally, we do have a regulator that looks at competition issues, the Competition Commission of India. It's very active, and it has been taking action every time it sees abuse of dominance, and there's no reason to believe that it won't in the future. That's all we have for you in this episode. Thank you so much for watching. But before you go, I actually have an appeal to make to you. A lot of the reporting that we do at ThePrint, which we are very, very proud of, is in depth and well researched, and a lot of times we go out to various places to report on stories that nobody else is bringing to you. Now, this comes at quite a large cost, not just in terms of time and effort, but also, of course, money. And that's where I encourage you to please subscribe to The Print. The link is in the description of this video. Your subscription allows us to do more of this work, to do more shows like this, and to add value to the news for you, our subscribers. And not only that, it gives you several benefits as well. You get priority passes to our exclusive, subscriber exclusive webinars and our on-ground events. You can write for us in our Your Turn section. You can write your own opinion. You can write an article for us. And also, we have regular newsletters from our editors that go out every day and also every week. And so you get access to all of that, where our editors can tell you and talk to you about the news of the day and of the week. So please do subscribe. The link, as I said, is in the description. And thank you so much for watching.